Hello, welcome to our webinar, and thank you for taking the time out of your busy day to join us. We're happy to partner again with the Options Clearing Corporation, or OCC, to bring you this webinar today on how to generate income with credit spreads. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, Investrade. A few quick housekeeping matters. The session today will last about 1 hour. Our speaker will present for approximately 50 minutes, and then he'll address your questions for the last 10 minutes or so of his presentation. We ask that you look now to locate the Q&A box on your screen. If you have any questions at all during the webinar, please feel free to type them into the Q&A box throughout the presentation, and our speaker will answer those at the end. We ask that you use the Q&A box and not the chat box, as our speaker will only see what's in the Q&A. To tell you briefly about eOption, as our name implies, we're a brokerage firm that specializes in options and stock trading. We offer you some of the lowest rates around, including zero commission on stocks and ETFs, and options are just 10 cents per contract plus $1.99 per trade. Our founder was one of the founding members of the Chicago Board Options Exchange and has been an active stock and options trader for nearly 50 years. He created his ideal trading company that caters to those who have a passion for investing. At eOption, we support trading education, and we usually do 1 to 2 webinars per month with industry experts, and we hope you'll continue to join us. We also encourage you to subscribe to our YouTube channel to see our library of trading videos, no matter what level of investing you're at. You can take a moment right now to go to youtube.com/eoption to subscribe if you'd like, and we also put a link in the chat box if you want to click on that and quickly subscribe as well. And now I'd just like to turn your attention to our disclaimer real quick. And at eOption, we encourage you to make your own investment decisions. If you could just take a quick look at this, and I'd like to bring your attention to the 4th bullet point, where options carry a high level of risk and are not suitable for all investors. Certain requirements must be met to trade options through Regal or any of its divisions. And there's also a booklet that you can see there entitled Characteristics and Risks of Standardized Options with a link, or you can contact us and we'd be happy to send you a booklet on that. So now I'd like to turn our attention to our speaker now, Ken Keating, who is a principal of investor education at the Options Clearing Corporation. Ken has been a trader for 25 years and has worked on the trading floor of the Pacific Coast Stock Exchange and the Chicago Board Options Exchange. He has held positions as a floor market maker, floor specialist, risk manager, and off-floor prop trader. He's also worked as an options portfolio manager as well as trading for himself. So without further ado, I'll turn it over to Ken now. Thank you.
Well, thank you, Gina. Thank you for that kind introduction. And welcome everyone to today's presentation. As Gina mentioned, my name is Ken Keating, and I'm a principal at OCC Investor Education, as well as an Options Industry Council instructor. And I'm going to be giving today's presentation on potential income generation with credit spreads. So before we get started, I do want to send a big thank you to Gina and Eric and all the great people at eOption for all they do for the ever-growing community of options traders with their competitively low rates and their amazing trading platform. So before we get started, I know Gina mentioned her disclaimer. We have a very similar disclaimer that we have to post. So anybody who's looking to trade options should certainly read the characteristics and risks of standardized options. You can ask your broker for a physical copy or any of the exchanges which options are traded for a physical copy, but you can also go to our website, optionseducation.org, and we also have a digital version if you prefer that as well. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies discussed here today are strictly for illustrative and educational purposes. All right, here are some of the trademarks and logos that you will see throughout the presentation. These are owned by OCC and are strictly for all the lawyers at OCC, but we do have to post it. A quick bit about OIC. Who exactly is OIC? So OIC, who I work for, OIC, the Options Industry Council, we are effectively the education arm of our parent company, OCC. So as many of you know, OCC is the Options Clearing Corporation. and is the world's largest equity derivatives clearinghouse for exchange-listed options, as well as the foundation for secure markets in the United States. So we started out as a collective in 1992 to better educate the public both on the risks and the benefits of exchange-listed options. And we do that primarily through our website, optionseducation.org. There you'll find free online podcasts, videos, webinars, and online courses. And this is completely, this is a service that we provide free of charge because we are fully funded by our parent company, OCC. So just know that even though this is a free service, we are not registered advisors. So we cannot talk to you about specific stocks, setups. We cannot direct you on trades, guide you in any way, but we can talk to you about options theory, options strategy, or say how a corporate action can impact your options position. So if you ever have questions regarding any of those topics, you can reach out to us at options@theocc.com, Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time. We have a very deep bench of knowledgeable people on our team, all ex-traders and brokers. All said and done, we have probably about 100, well over 100 years of trading and brokerage experience on our desk. So if you ever have a question, you can always just shoot us an email, options@theocc.com. All right, some more information. Once again, our website, email, and we too have a YouTube channel where we archive many of our past webinar presentations. So if there's a subject that you're more interested, you want to study a little more deeply, you can go to our YouTube channel, search by topic, and we've done dozens of videos on just about any subject that you can think of regarding options. And once again, this is a free service. Okay, this is the updated annual options volume over the last 23 plus years. So as you can see, the options product has really just taken off in popularity. I remember when I left the floor back in 2000 here, and this is right around the crest of the internet bubble. And back in 2000, we were doing about 2.8 million contracts a day. And at the time, it felt like a lot of volume. And at the time, it really was a lot of volume. But you contrast that today, where we are clearing and settling on an average daily basis, roughly 44.5 million contracts. So as you can see, last year was a record year for OCC, where we cleared and settled 10.3 billion contracts. Halfway through this year, through the end of June, we've already cleared and settled 5.5 billion contracts. So if things stay the way they are, we are surely on track to at least meet or exceed last year's record numbers. So no lack of investors using the product both to hedge and speculate amidst all the volatility that we've witnessed over the last 2 decades. Okay, so here is today's presentation outline. So specifically today, I'm going to be talking about credit spreads. We're going to be talking about selling credit spreads to potentially create an income stream. But before we start, we're going to be talking about basic spreads. What exactly is a spread? And then we will get into the 2 different types of credit spreads. We'll be looking at the bear call spread. We'll then look at the bull put spread. Throughout the presentation, we will examine strike selection and duration, because that's always an important part when deciding what strikes, what durations, your forecast, whatnot. So we'll be looking at that. And lastly, we will be looking at assignment risk, because anytime you are trading options, at least American style options can be exercised on or before expiration for whatever reason the long holder wishes. So when we do a spread, we're long one option, short another option. So by being short an option, we are technically open to assignment risk. So we'll talk about why somebody might exercise early and some of the mitigating things you can do to avoid an unwanted assignment. Okay, so let's get started. So spread basics. So when we're talking about a spread, typically when we're talking about an option spread, what we're talking about is the buying of one option and the selling of another option against it, or the selling of one option and the buying of another option against it. Okay, so the options may have the same or different underlying assets. may have the same or different expiration dates if two or more options are involved, and may have the same or different strike prices if two or more options are involved. So we're going to be looking at spreads that are going to be done one-to-one. And in other words, if we buy an option, we're going to sell only one option against it. We're not going to buy one option, sell three. That would be known as a ratio spread. So when we're talking about spreads, we're going to be looking at doing them one-to-one. And there's different types of spreads. We're going to specifically be looking at credit spreads and vertical spreads here, but there are other types of spreads as well. There are horizontal spreads known as time or calendar spreads. We'll take a look at that really quick, as well as diagonal spreads, which are kind of a combination between a vertical and a horizontal spread. So how do you know whether you're trading a vertical, calendar, or a diagonal? Okay, so it really doesn't depend on whether you're using calls or puts. It really depends on the construction of the spread, how you construct the spread. So if we're looking at a vertical spread consists of buying one option in the same month at one strike and selling another option at another strike against it, all within the same month. So in this case, if let's just say we were bullish on the stock and we bought the 87.5 calls for 261 in October here, and then we simultaneously sold the 95s against it, okay, for 52.5 cents. So we would put on, that's called a debit spread. That's a bull call debit spread. And we would be looking for the stock to make a bullish move higher, hopefully finishing at 95 or higher, where the spread at expiration would have its full value of $7.50 less the debit that we paid. But that's an example of a vertical spread. If we were using puts in the same month, that would also be known as a vertical spread. Now, a calendar spread or a time spread involves the same strike within 2 different months. So this is more of a volatility play. So let's just say we decided to buy the January 100 calls here for $1.98 and simultaneously sold the November 100 calls for 78 cents. Okay, so this is a calendar spread. And we would put this spread on if we were, say, long-term bullish, but near-term more neutral to bearish. So ideally, we would like this stock to close right at 100, hopefully, technically below 100, where this November 100 call would expire worthless. And then after November rolls off, we would be left with the long Jan 100 call, and hopefully the stock would make a bullish move. So this is a volatility play, and we would only put this on if we were near-term neutral to slightly negative on the stock, but then longer-term bullish. Now, a diagonal spread is a combination of both a vertical spread and a calendar spread. A diagonal spread involves different months at different strikes. So an example of this would be, let's say we bought the January 2025 87.5 calls for $12.64. And we turned around and we sold the April 95 calls against them for $5.17. And once again, we would put this spread on if we were longer term bullish and near term neutral. So ideally, we would like the stock to make kind of a slow bullish move from 87.5 higher. And hopefully at expiration, at April expiration, the stock closes at 95 or lower, where these options, these 95 calls expire worthless. Then we would be left with these Jan 87.5 calls, and hopefully the stock would make a move higher, or we could choose to sell other calls against it or structure, however we want to manage these Jan 25 calls. But the idea is, if these April calls expire worthless, that lowers our cost basis on the Jan 87.5 calls. But that's an example of a diagonal spread. But today we're going to be talking about vertical spreads. So once again, vertical spreads involve either all calls or all puts within the same expiration at different strikes. So an example of a debit spread is when we buy, in the case of calls, if we buy the 85 calls here and sell the 90 calls against it, traders would say, by doing that spread, we would say we're long the 85-90 call spread. Okay, so the investor purchases the more expensive strike and sells the less expensive strike. So examples of debit spreads are a bull call spread or a bear put spread. Now, today we're going to be talking about credit spreads. So a credit spread involves when we sell the more expensive strike and we buy the less expensive strike. So in the case of these January options, let's just say we decide to sell the 80 calls here and we buy the 90 calls against them. So now we would have the bear call credit spread on, and obviously these 80 calls are going to be trading for more than the 90 level calls. And by doing so, by selling the 80s and buying the 90s, we're going to receive a credit to put on this position because the 80s are more expensive than the 90s. So that credit that we receive is ours to keep. Not that they're to say there isn't risk in this position, but when you sell a credit spread, you know your defined risk and reward are defined ahead of time. So why do people like trading spreads? Why do traders like trading spreads? Well, it allows you to trade with your eyes wide open because, once again, your defined risk and defined reward, you know that up front within the spread. So in the case of a debit spread, as we mentioned before, the maximum risk is the debit that you paid for the spread, and the maximum reward is the difference in strike less the premium paid. So if I buy the 85-90 call spread for $2, okay, my maximum risk within the spread itself is $2. My maximum reward is the difference in strike, in this case, $5, the difference between 85 and 80, less that debit that I paid, $2. So 5 minus 2 is 3. So in this case, if I bought the $5 call spread for $2, I'm risking $2 to make 3. Now, obviously, if I buy a debit spread, somebody has to sell me that spread. They're going to have on the credit spread. And in this case, their maximum risk is the difference in strike less the credit received, and the maximum reward is the net credit received. So if I sell the 85-90 call spread for $2, the most I can make on that position is that $2 credit. And the most I can lose is the difference in strike, $5 less the credit of 2, that's $3. So in this case, ideally putting on a credit spread, you want both options to expire worthless or out of the money, so you end up keeping the full value of the credit that you sold that spread for to begin with. Now, this is a really important concept, and I can't stress this enough. Spreads, the defined risk nature of any spread only exists within the spread itself. So an exercise or an assignment may change the risk reward parameters of that position. So what do I mean by that? So let's just say I buy the 100-110 call spread, and I put this on weeks ago, and all of a sudden the stock is now trading 120. And for whatever reason, I decide to exercise my 100 level calls. Well, now I have a completely different position on. And before, I had a debit call spread with defined risk, defined reward. Now I'm long stock in 100 and I'm short the 110 calls. Okay, and that's called a covered call position. And it's probably one of the most popular strategies, but it's very different from that debit spread that I initially put on. So the risk and reward of a covered call position is very different from a debit spread. In fact, the risk in a covered call position is in the long stock position, because if all of a sudden the stock rolls over, technically stocks can go to zero, right? So when you put on a covered call position, your risk is in the long stock position. So once again, just pointing out the fact that that defined risk nature of a spread only exists within the spread itself. And we'll be looking at some examples later on, but I just want you to keep that in the back of your mind because it's a very important concept. Okay, so now let's look at a couple examples. Let's first look at the bear call spread. Now, we always get questions at OCC about, well, if I'm bearish, why would I put on a bear call credit spread instead of a bear put spread, a debit spread, a bear put debit spread? And really the answer lies within interpreting implied volatility. Now, I'm not going to get into an extensive talk about implied volatility today, and I've given talks about it in the past, and it really is a crucial aspect of trading options. But simply put, implied volatility allows traders to measure the level of options prices. So when options prices are, when implied volatility is low, it infers that option prices are low and option prices are inexpensive. And when implied volatility is high, when the market's moving around and stocks are going up, they're going down, they're making crazy moves, implied volatility tends to expand, option prices tend to get more expensive. So just like any product, whether it's a stock, a bond, a commodity, traders generally like to buy low, sell high. So when implied volatility is high, traders generally like to sell options, be a bigger seller of options than a buyer. When implied volatility is low and option prices are inexpensive, option traders typically like to gravitate to being, trading from the long option side, typically. But just know that when you sell options, there's a considerable amount of risk anytime you sell options. So if I sell calls outright, I have unlimited risk to the upside. In theory, stocks have no limit to how high they can go. Technically, they can go to infinity. Now, I've never seen a stock go to infinity, but I've certainly been on the wrong side of a short stock position that felt like it was going to infinity. But, there is risk there. And just like on the other side of the equation, if you're short puts, your risk is down to zero on the security. Say the stock goes into bankruptcy or delists, liquidates for whatever reason, your risk in a short put is down to zero. But let's just say, how can we take a bearish or bullish view and still hedge ourselves? Well, that's where the bear call spread or the bull put spread comes in. So if we have an expectation of neutral to declining share prices, what can we do? And we've established that implied volatility or option prices are high. So we can sell calls or sell stocks short. Well, selling calls outright obviously has unlimited risk to the upside, as well as selling stocks short. Okay, you're going to receive premium from those sales, but you certainly have a lot of risk. So to offset the risk of increasing share prices, we can sell one call option and buy an out-of-the-money call as protection to limit our risk, thus establishing the bear call credit spread. So let's look at a hypothetical situation. So we have DOLR. This is a fictitious financial services company, and we're looking for this stock to be kind of neutral to slight, go down slightly. We're not very bullish on it. So once again, we can sell 100 shares short. There's no profit if the shares stay flat and no protection if the stock rallies. It may also require significant margin. Same thing with selling calls outright. We do receive premium from the sale of those calls, but once again, we have unlimited risk to the upside and may require significant margin. So we're going to sell one call and we're going to buy a further out of the money call against it, take in a net credit. That's going to reduce our upside risk as well as lower our margin requirement. So let's say DOLR is currently trading for $50. And over the next 60 days, we're slightly bearish. So we look at our options chain and we see that we can sell the at the money 50 strike call for $1.65. So we go out and we sell 5 of them. At the same time, we're going to turn around and buy 5 of the 52.5 strike calls. They're slightly out of the money for 65 cents. So all told, that's going to equate to a net credit of $1 or 100 per option contract. Because remember, a multiplier for a standard option contract is 100 because each contract is the right to buy or sell 100 shares. So if we net do the spread for $1 credit, in other words, we sell these 50 calls for $1.65, we buy the 52.5 for 65 cents. That's a net dollar credit. That's $100 in our pocket, but we remember we did it 5 times. So we're going to collect a total of $500 in premium by doing this. So what does this look like? What's our maximum gain, maximum risk? What are our break evens? Well, anytime you do a credit spread, your maximum gain is always going to be the net credit that you receive when you establish that spread. So in this case, $1 or $100 times 5 spreads, that's $500. That's our maximum gain. That's the most we can make on this position. What's our maximum risk? Well, our maximum risk is going to be the difference in strike, 52.5 and 50. That's $2.50 less this dollar credit that we took in. So $2.50 minus $1, that's $1.50 times 100, that's $150. But remember, we did it 5 times. So our maximum risk in this position is $750. So in this case, we are essentially risking $750 to try and make $500. Now, what's our minimum margin? Well, our minimum margin is going to be the potential maximum loss on this position, which ends up being $750. Now, margin requirements vary from broker to broker, so you'll want to speak with your broker specifically. But at a minimum, the margin is going to be an additional $750 you would have to have in your account to put on this position. So what is our break even on this position? Well, the break even, simply put, is the credit that we receive, this $1 credit, added to our short call strike. So 50 plus 1 is 51. So let's just say at expiration, this stock is right at 51. So at 51, we would neither make money nor lose money on this position. We would just break even. So let's look at this position in graph form, because some people are more visual and sometimes it's easier to see what this position looks like in graph form. So as we put on this bear call spread, we did it because we were bearish. And let's just say stock at expiration, let's fast forward to expiration. Let's say stock closes at 47.5. Well, at 47.5, both in theory, the 50 and the 52.5 level calls have no value and would just expire worthless. And we would keep the full dollar credit, which we took in when we sold the spread, times 5 spreads, that's $500. That's our max profit, and we would have no stock position. Now, if shares finish between 50 and 52.5, okay, let's just say shares finish at 51. Well, if we did nothing, we would surely get a sign on our 50 level call. We would be short stock from 50. Actually, we would be short stock from 51 because we took in that dollar credit. And our 52.5 level call would expire worthless. So if we did nothing and the stock closed at 51, we would wake up on Monday morning and we would be short, in this case, because we did the spread 5 times, we would be short 500 shares of stock with all the risks associated with being short stock. So if the stock opened on Monday morning above 51, we'd be sitting on unrealized losses. And if the stock opened up below 51, we would be sitting on unrealized gains. Now, granted, if the stock finished between 50 and 52.5 at expiration, most traders, to avoid an unwanted assignment, would mitigate this by purchasing back, either closing out their spread or at a minimum buying back this short 50 call. Once you buy back this short 50 call, you no longer have assignment risk. So technically, most traders, they don't want to deal with a stock position on Monday morning. So most likely they would close at a minimum this short strike on or before expiration. Now, if the shares finish above 52.5, what happens? Well, that's where our maximum loss entails. So let's just say we put on this bear call spread because we were bearish. All of a sudden, it didn't work out. Stock rallied. Let's say it closed at 55. Well, at 55, if we did nothing, we would be assigned on our 50 call. We would be short stock at 50. We would exercise our 52.5 level calls. Okay, so in fact, we would be buying stock at 52.5. We would sell stock at 50. That's a $2.50 loss on 500 shares. But remember, we took in $1 credit when we established this position. So once again, our max loss, the difference in strike less the credit, we received $1.50 times 5. That's $750. With the stock above 52.5, our max loss would be achieved. We would have no stock position, but we would still suffer the maximum loss in this case. Now let's look at the bull put spread. So why would we put on a bull put spread? Well, let's just say we've analyzed implied volatility, have come to the conclusion that volatility levels are elevated, but we are bullish on a particular security. So if we're bullish on a security, what can we do? Well, we could just sell naked puts, also known as cash secured puts. But once again, this offers us no protection at the downside, except for the premium that we receive, and we have risk all the way down to zero should we get assigned on these puts. We could go out and buy stock, but know that buying stock outright can be a capital intensive endeavor and doesn't provide us any protection if the shares plummet. If we're looking at a $250 stock, it's going to cost you $25,000 to buy 100 shares. So that's buying stock can be very capital intensive. But if we're bullish and we've established that option prices are somewhat elevated, we could put on a bull put spread. So what we're going to do is we're going to sell one put and then buy a lower strike out of the money put against it to limit our downside risk. So what does that look like? So we have a fictitious soft drink company here, BUBL. It's trading at $115. And instead of committing $11,500 to buy 100 shares, we're going to look to sell puts. So we look at our options chain and we see that we can sell the 115 strike put. And at the same time, we're going to buy the further out of the money strike 110 strike put to offer us some downside protection should the share price fall. So we look at on our options chain and we see that we can sell the 115 strike put at $2. At the same time, we can pay 70 cents for the 110 put. Okay, so that's going to, when you do the math, that's a net credit of $1.30 or $130 that goes into our pocket. So what does this look like? Well, our maximum gain on this position, as it's a credit spread, is going to be the difference it's going to be the credit that we received when we initiated the position. In this case, $1.30 or $130 per spread. Our maximum risk, once again, is the difference in strike, $5, 115 and 10, the difference, that's $5, less the 130 credit that we took in. That gets us to 370 times 100 because the multiplier is 100, that's 370. So in this case, our maximum risk would be $370. So if we put on this bull put spread for $1.30, we're essentially risking 370 to make 130. Our minimum margin is always going to be the potential maximum loss on this position, in this case, 370. But once again, this will vary from broker to broker. And our break even at expiration in this case is going to be the short put strike, 115, less the net credit of $1.30. When you do the math, that gets you to 113.70. So at 113.70 at expiration, this position neither makes money nor loses money. Okay, so now let's look at the bull put spread in graph form. So there's our break even, 113.70. If the shares go our way, let's say shares finish at 120 at expiration. Well, in theory, both the 110 and the 115 put expire worthless, and we end up keeping the $1.30 credit that we initiated the position at and our maximum profit potential. And we would have no stock position. If the shares finish anywhere between 110 and 115 and we do nothing, we would surely get assigned on our 115 puts, and our 110 puts would expire worthless. Effectively, we would be long stock from 113.70 on Monday morning, and with all the risks associated with being long stock. So once again, if the stock finished somewhere between these strikes, most likely most traders would at a minimum buy back their short 115 puts or try and trade out of this spread at a price so they don't have to deal with an unwanted assignment situation. Now, if the shares finish below 110, okay, that's the worst case scenario, but because we have it on as a spread, we know that the most we can lose is 370. So let's say the stock closes at 105, both the 115 and the 110 put expire in the money, okay? And we would get assigned on our 115 puts, effectively buying stock at 115. We would exercise our 110 puts, selling stock at 110. That's a $5 loss. But remember, we took in $1.30. So once again, there you go. $5 minus the $1.30 credit. Our maximum loss of 370 would be achieved, but we would have no stock position. All right, so we always get questions at OCC and OIC. What is the ideal strike and expiration selection? And, this is going to be, there is really no perfect answer because your idea of duration and strike selection is it's going to vary from investor to investor. So my idea of what's risky is going to be very different from your idea of what's risky. And my forecast could be bullish and your forecast could be bearish. So it really is dependent upon the individual investor. So anytime we are putting on these positions, strike selection is very important. Now, selling in the money strikes in a credit spread certainly offers you greater reward because you're taking in more premium, but it also opens you up to a greater likelihood of assignment. So ideally, when we put on a credit spread, we want both options to expire worthless, ultimately leaving us that initial credit that we sold the spread for, and thus that's the term. It's a credit spread. We want to keep the full credit that we sold the spread for. And anytime we put on a credit spread, the long strike, as in the case of the bear call credit spread, is our upper price boundary range for protection in case things go against us. And with the bull put credit spread, the long lower out of the money strike put is purchased for protection in case the stock goes south. So the long strike is our protection, but ideally we want both strikes to expire worthless when we end up keeping the full credit. Okay, we also get questions about short-term versus long-term. Once again, this is going to be an individual choice. So obviously longer-term options are going to be comprised of a greater amount of premium, but obviously when you sell longer dated options, there's more time for things to go wrong. So one of the things that people like to do who sell options, typically option sellers usually like to target options that expire anywhere from 30 to 45 days to expiration. Why is that? Well, all options decay, but options that are shorter dated decay at a more accelerated rate than longer dated options. It's called theta, and it's the Greek theta is how you measure how much your option loses value every single day until expiration. And theta does not decay in a linear fashion. It decays in an exponential fashion. So right around the 30 to 45 day mark is where options start to, the slope of the decay gets a lot steeper. In other words, these options that are near dated decay at a greater rate than their further dated counterparts. So once again, the end game for selling investors, people who sell options, is to have your spreads expire out of the money and worthless. And, you certainly can sell credit spreads further out in time, but once again, there's more time for that position to go against you. And, like I said, the sweet spot for people who like to sell options is typically 30 to 45 days because you get that added decay from the from the options up until expiration. So once again, option theta is a friend to option sellers and a foe to option buyers, because as we get closer and closer to expiration, those options are worth less and less, and that's going to benefit people who generally a bigger seller of options than a bigger buyer. So once again, that 30 to 45 day mark is about the sweet spot for people who like to sell options. All right, so now let's look at assignment risk. So once again, anytime we're trading American style options, which is what we're trading here, anytime we're short American style options, we are open to early assignment. And just to keep in mind, for somebody to exercise a contract early, there has to be an economic incentive. Now, if I own a call, it's my right to exercise that call anytime I want. I can exercise that call 2 weeks in advance if I want and take delivery of shares. But remember, if I have a call and I exercise it 2 weeks early, any time premium left in that option would be foregone by me, the option holder, and that would accrue to whoever got assigned. So by effectively exercising early, I'm in a sense accelerating my expiration. So why might somebody exercise early? Well, the biggest reason why somebody might exercise an option early is in the case of a dividend. So let's just say I put on the 100 110 call spread. I bought it. Let's say I sold the 100 110 call spread. I'm short the 100 calls. I'm long the 110 calls, and all of a sudden the stock is trading 120. Okay, both options are in the money, and let's just say both those options are in the money. And my short 100 calls, obviously they're $20 in the money because stock's trading 120, and maybe they're trading $20.20. And let's just assume tomorrow that the stock is going ex-dividend for 50 cents. Well, because that dividend of 50 cents is larger than the 10 cents of time premium in my short option, that option is a strong candidate to be exercised early for a dividend. In other words, somebody who's long that option is incentivized to exercise early, forego the 10 cents of time premium left in that option to capture a 50-cent dividend. So if you're somebody who likes to do covered calls, or you're putting on credit spreads in stocks that pay particularly large dividends, you're going to want to know this formula. Once again, if the dividend amount is greater than the extrinsic value left in the option, that option is a strong candidate to be exercised early, typically the day before the ex-dividend date for the dividend. So you'll want to, if knowing that, you can take some mitigating measures, buying back your short, maybe rolling your spread to a higher spread, or a minimum buying back your short option, and maybe exercising your long option to capture the dividend if that's something you want to do. Now, the other reason why somebody might exercise a call, in the case of calls, a call early is a hard to borrow situation. So what is a hard to borrow situation? Well, people who like to bet against stocks, hedge funds, prop traders, typically they will sell stock or indexes short today with the hopes of buying them back tomorrow or further down the road at a lower price. That's how a short seller makes money. And let's just say that the stock, everybody's betting on the stock going down. In other words, everybody and their mother is short the stock, and maybe the float of the stock, 90% of the float of the stock is sold short. In that case, that stock might be known as what is known as hard to borrow. So remember, if you want to sell a stock short, you have to borrow that stock from your broker. They have to borrow it from somebody who's long it. And if there's not a lot of stock to borrow, your broker might say, okay, well, we'll let you sell this stock short, but we're going to charge you what's known as a negative short rate. So if the negative short rate that they're charging you is greater than the extrinsic value in the option, that option might be a candidate to be exercised early for long stock. So if I'm short a call and it has 10 cents a time premium, but the hard to borrow rate on the security is from between now and expirations 30 cents, somebody might forego that 10 cents to not have to pay the negative 30 cents on a short stock position. So once again, the main reason why somebody might exercise a call early is really for a dividend. The other reason is in a hard to borrow situation. Now, puts, on the other hand, why somebody might exercise a put early is if the short interest to be received from being short stock is greater than the extrinsic value left in the option. So in a normal stock, let's say the stock isn't hard to borrow. Typically, if you want to sell stock short, you can sell the stock short. You deposit the funds in your account. Your broker pays you what's known as a short rate, and you gain a little interest by the balance from the sale of the stock, and that's known as the short rate. But if the short rate that you could receive on being short stock is greater than the extrinsic value left in the option, that option is a strong candidate to be exercised for the short interest. So I remember in the late 90s when all these internet stocks were around and you had some very high dollar valued stocks were trading $200, $300, and you had many different strikes, and interest rates were a lot higher back then. So when interest rates were higher, there was, depending on the strike you're looking at, there might have been an incentive there for somebody to exercise early for this short interest. but that's the reason why somebody might exercise a put early. All right, so now let's look at a couple risks. And this really kind of ties it all back to this idea that the defined risk nature of a spread only exists within the spread itself. And an exercise and assignment may change the risk reward parameters. So going back to our first example, let's just say we shorted the 52.5 bear call spread for $1. Stock at expiration closes right at 49. Okay, so we figure that both options are going to expire worthless. We're going to keep this full dollar credit. We turn off our computer screen at the end of the day. Well, let's just say some after hours news comes out 10 minutes after the close and pushes stock up to 55. Well, even though the stock closed at expiration, and this is a really important concept to keep in mind, a lot of investors think, well, my expiration's over. Stock closed at 49. Both these options expire worthless. Well, that in theory, that's the case. But keep in mind, you still have assignment risk by being short this 50 call. So if somebody decides to exercise their call in the aftermarket, you could very well be assigned on this call. And if you turn off your screen at 4 p.m. on Friday, you could wake up on Monday morning short 100 shares of stock, or in this case, because we did the spread 5 times, 500 shares of stock with the stock trading $5 higher. So where you thought you were sitting on $1 credit, that, $100 or $500 profit, you're in fact sitting on a $2,000 loss because you're short stock from $51. It's now trading 55. Okay, so you still have assignment risk on this short 50 call. So what can you do? Well, this is why traders generally like to cover their short strikes. There's an old saying on the trading floor, when in doubt, close them out. So, and people say, well, God, stock closed at 49. Why would I buy back this 50 level call for a few pennies or a nickel? It's out of the money. It's worthless. Well, 99 times out of 100, both these options with the stock closing at 49 is probably going to expire worthless. But it's this one time in 100 where all of a sudden some news pushes your stock higher. Somebody now exercises this call for 50, probably sells stock in the aftermarket for 55, locks in a quick profit, and you wake up and you find yourself short stock on Monday morning. So once again, the only way to mitigate against an unwanted assignment is to either close out your spread entirely or at a minimum, buy back this short 50 call. Now, keep in mind that there's something known as X by X processing. X by X processing is administrative convenience by our member firms that OCC extends to our member firms, where options that are a penny or more in the money get automatically exercised. So if stock closed at 49, technically somebody would have to manually exercise this 50 call in order to take advantage of that. Now, we require that our member firms get their exercise and assignment notices into OCC, into the exchanges at least, by 90 minutes after the New York close. In other words, 5:30 p.m. Eastern Standard Time. Now, some brokers have a very different cutoff threshold. So you'll want to speak with your broker and ask them what their exercise cutoff threshold is. Because I've heard of exercise cutoff thresholds for some brokers, some very notable brokers are as little as 10 or 15 minutes after the close. So you'll want to check and see. Some brokers extend that window to 90 minutes. Some give you a 10 or 15 minute window, but just know that you still have assignment risk, even though the stock closed, both these options closed out of the money, stock closed at 49, some news pushes the stock higher, you still have assignment risk on these 50 calls if you did nothing. So once again, the defined risk nature only exists within the spread itself, and exercise or assignment may change those risk reward parameters. Now let's look at the risk in the bull put credit spread. So in this case, we sold the 115, 110 bull put credit spread up for 130. We pocketed 130. Stock closes at 116. It appears both options are going to expire worthless. But then after hours news comes out and the stock drops to 105. Okay, well, once again, you still have assignment risk by being short this 115 put. Okay, and if you did nothing, you might find yourself long stock on Monday morning through an assignment from this 115 put. So once again, the only way to mitigate against this would be to buy back this 115 short put on or before expiration. Now, once again, if you now I can't mention the particular stock, but it was a very notable stock, and this happened a couple years ago. And there was a lot of people who were short bull put credit spreads or just cash secured puts, thinking that this particular stock was going to. I think it closed at oh my God, I think it was like 320 or something. It was very high, but then all of a sudden in the aftermarket, the stock dropped 100 points on some bad news. And people who didn't see the news, once again, if the market's closed, you can't buy back your short options, okay? But a lot of people got a sign on their on the short legs of their bull put credit spreads or their cash secured puts, and woke up on Monday morning long lots of stock in a stock that's down 100 points. Okay, so once again, the only way to truly mitigate against an unwanted assignment is to buy back your short options on or before expiration, because, like I said, this does happen, and it's a risk you got to keep in the back of your mind if you're trading spreads. Okay, so how about managing the position before expiration? So what happens if we put on the bear call credit spread and the market doesn't go low, it goes higher, it goes against us? Well, we know within the spread itself, we know how much we can make, how much we can lose. So we know our defined risk, okay? We know what the maximum loss is. If implied volatility goes up in the near term, that's going to mark prices against us, okay? In other words, option prices are going to expand, and that's going to hurt the value of our spread because we're short the more premium heavy option and long the out of the money option for protection. So what can we do in that case? Well, we could roll the position. So in the case of the 52.5 call spread, if all of a sudden the stock goes higher, goes up to 52.5 2 weeks before expiration, we could roll the entire spread higher. In other words, we could buy back our short 50 call, sell to close our 52.5 strike call, and then maybe sell the 55 strike call and buy the 60 strike call, or sell the 52.5 strike call and buy the 55.5 strike call, or 55 strike call. We could also roll up and out. In other words, roll to a further longer term duration and thus take in more premium. What if we put on the bear call credit spread and stock all of a sudden pops really quick, and maybe we think it's just a short squeeze? Well, we know that the most we can lose on the position is the difference in strike less the credit we took in. So maybe if we thought that the stock is going to potentially roll back over, we could just hold the position, because once again, we know what our maximum risk, maximum reward is. So these are all the options that you have at your disposal. Now, in the bull put credit spread, once again, we're putting this position on because we're bullish, but sometimes the market doesn't work out the way we want it to. If the market goes against us or implied volatility goes higher, that's going to lead to increasing prices, which is going to hurt us. So what can we do in the bull put credit spread? Well, just the opposite. We could roll the entire spread down, okay? Buy back our short puts, sell to close our long puts, and roll the entire structure down further to give us more breathing room, or roll down and out in order to take in additional premium and a little more time for our forecast to pan out. And once again, we can always just hold the position, or just close it and live to fight another day. Those are all options that you have at your disposal. So I know that was a lot of information, and if you want to once again, if you have any further questions, you shoot us an email at options@theocc.com regarding this presentation. I know that there is, I'm posting e-options disclaimer here, but I am going to take a look at the Q&A box and see if there's some Q&A we can tackle. I know we've got a few minutes left over, about 5 minutes. So let's see. So somebody asked the key, let's see, what is your determine being? Okay, so somebody says they understand credit spreads, but they have an issue in determining, how to determine being bullish, bearish, which option strategy to use. So, once again, the idea of with any strategy, not just the credit spread or any option strategy, you really want to start from analyzing where implied volatility is, the level of implied volatility. And many brokers have embedded in their platform tools that allow you to measure implied volatility. You can look at implied volatility charts. Some brokers have IV rank, IV percentile. These are other tools that you can use to analyze volatility. But you really want to do is you can only take what the market's giving you at any given time. So all you can do is trade the level of implied volatility offered. So when implied volatility is high and you're bullish, that might be a situation where you might consider putting on a bull put credit spread. Okay, you're bullish, you want the stock to go higher. It allows you to sell high implied volatility while also defining your risk and protecting yourself. On the flip side, if you're bearish and implied volatility is high, you might consider a bear call credit spread. Once again, it allows you to sell that high implied volatility, buy a higher strike against it for protection, and still take a bearish viewpoint. So once again, it's really going to be dependent upon your individual risk tolerance and forecast and the level of implied volatility. So you want to the starting point is figuring out where volatility is, whether it's expensive or cheap or somewhere in between. Figure out whether you're bullish, bearish, or neutral, and then you apply the appropriate strategy that you want based on your forecast. Okay, let's see. Somebody was asking, that was a lot of information. Are we able to watch this again? And I believe Gina can answer that, but I'm pretty sure all these webinars are recorded and you should have access to the recorded version of this webinar. And if you, I believe that there you can get a PDF of the webinar deck I presented. And if not, you can always send us an email at options@theocc.com. Tell them, just detail that you saw this webinar presentation and we can shoot you a copy of the deck as well. Let's see. Somebody was talking about, never heard of hard to borrow. Can you expound? Okay, so once again, hard to borrow is a term used to describe being short stock. So you can either, most people trade from the long side. They're generally long stocks, long bonds, long commodities, but some people like to sell stock short. They're called short sellers, and they like to sell something today and with the idea that you're buying it back tomorrow at a lower price. And by selling something short, you have to borrow it physically from somebody who owns it. Okay, your broker goes out. If you want to sell stock ABC today, you have to borrow it from your broker. They have to go out and borrow from somebody who's long the stock. Allows you to short the stock. You take those proceeds, you sell the stock today, you take the proceeds, put it in your account, and then hopefully you buy it back at a lower price some time in the future. When everybody's on the same side and is trying to short the shares, there might not be enough stock to borrow for everybody to short those shares. It becomes what's known as hard to borrow. In other words, it's very hard for your broker to locate shares for you to sell short and borrow. In that case, either one, your broker will say, no, you can't borrow the stock. You can't sell it short. You just can't borrow it. Or two, yeah, we'll let you sell the stock short, but we're going to charge you a premium. In other words, it's called a hard to borrow rate. In other words, instead of getting paid to be short stock, which in its normal situation, you would be paid a little interest by the proceeds of the short sale by your broker through the short rate, you would be actually paying to be short that stock. And once again, hard to borrow situations generally happen in stocks that have, gone parabolic, like the meme stocks, as many of you remember back 3 years ago, 3 years ago, some of these stocks went parabolic. And I remember one stock went from 30 to 800. And it was just clearly a short squeeze. And everybody, all these hedge funds were shorting the stock, but the stock continued to go higher against them. And it became harder and harder to borrow as more and more people were trying to sell those shares. And sometimes that gets reflected, and this gets a little more esoteric, but sometimes that gets reflected in what's known as put call parity. And when a stock gets very hard to borrow, once again, there's this relationship between options, between calls and puts that share the same strike in the same month. Typically, it's called put call parity. But in a hard to borrow situation, because there's a premium being charged to being short stock, sometimes the puts can be trading at a higher price than the calls. And it looks like there's an arbitrage there, and there really isn't. It's just, it's being baked into the price of the options, that short rate that brokers are charging the people who want to be long puts. So, just know, like anytime you look at your option screen and something looks too good to be true, just know that there are no free lunches, really. The market's very efficient. So if you see something that looks too good to be true, it probably is. So with that, I know we're right up against our limit here, but I want to thank you for joining us here today, and I appreciate your time. And I love doing these webinars, but I'm going to bring back Gina for closing remarks. But I hope you got some value out of this, and I look forward to speaking with you on the next subject.
Okay, great. Well, thank you so much, Ken. That was very interesting and informative. And thank you to all of our attendees for taking the time out of your busy day to join us. And I just wanted to highlight a few resources before we all go that I think you would find useful. First, some people asked in the Q&A if a recording is available, and Ken touched on that in his Q&A. Yes, recording will be available tomorrow on our YouTube channel. So make sure you subscribe. You can go to youtube.com/eoption and just click the subscribe button, and you won't miss any of our videos. We're continuously updating that with trading videos from experts, no matter what level that you're at. So we highly encourage you to just go there and click so you don't miss out. Secondly, I know that there were some questions on there that may not have been answered. And so I encourage you, if you do have any additional questions, you can always email us at support@eoption.com, or you can give us a call, and our number's on our website. And we have a full trading desk, and they'll be happy to answer any questions that you have on options or different strategies. Whatever you need, we're here for you. We also have some resources on our website to learn more about options trading. We have videos, clickable option strategy links, and information on how to use our free trading tools. We do offer one that's pretty great called Options Play. And normally that's $500 annually, but we do give that free to all of our customers. So we encourage you to check that out. And you can find out more information on our website. And just if you could just turn your attention to the screen real quick, one of the great things about eOption is that we do offer some of the lowest rates around. So our stocks and ETFs are just zero commission, and our options are just 10 cents per contract plus $1.99 per trade. So it is some of the lowest around. So for example, if you trade 10 contracts, that's just $2.99. And if you trade 25 contracts, at just $4.49. And a lot of the other big firms, that trade would be over $16. So if you do trade options and stocks, the savings will add up for you. And for those of you that trade on margin, we do offer some of the lowest margin rates around. So we'd be happy if you go to our website at eoption.com, you can find out more information on that. And then if you turn your attention to the last point on the screen, we do have our next webinar next month on August 23rd, and it's on trade artificial intelligence using option strategies. And we do have a professional trader with over 30 years of experience, Teddy Keckstadt, who's going to show you live how he trades AI. So I think that one will be really great. So hopefully you could just go to that link, eoption.com/webinars, and reserve your spot for next month. And we do try to do 1 or 2 webinars a month. So we hope you'll continue to join us. So thank you again for your time, and have a wonderful afternoon. Bye now.